Brian Stokes, many thanks for your time. Something that a lot of people won't know about Seven Group Holdings is the amount of money it's generated to pay down the debts that you took on to buy the building materials giant Boral. It's happened very, very quickly for what has been a big and recent acquisition.
Yeah, correct. It's always our confidence in the quality of our businesses and industrial services businesses and their ability to generate free cash flow. I think WesTrac's been a stalwart in being able to generate significant cash flow, and ultimately the performance of WesTrac, performance of Coates enabled us to take on leverage to acquire shares in Boral and effectively get to the 70% position we have, and then know over time the cash flow from those businesses were able to pay down that debt. So we went from a peak at 2.8 times to now 1.9 times in the space of
so in billions. How much is that money you've come down from and to?
Look, from a total debt perspective, we took on to acquire the business about $6 billion in a bridge facility, and we paid that down. We're today, we sit about 3.7 billion of net debt, and from our perspective, the earnings of our business, and growth outlook and cash flow gives us immense confidence in that being, a really, solid conservative position on balance sheet.
So there's some sense in your business that I can see, at least anyway. You've got Caterpillar through WesTrac, you've got Coates Hire, which is hiring out to businesses large and small, and then you've got Boral with the building products that it's got, concrete in particular. So all of these things seem to fit. Now you've got the debt sort of under control. Is there another leg to all this?
Yeah, we've spoken quite consistently around the focus on three core sectors in mining production, infrastructure and construction, and transitional energy, and that's where we've looked to deploy incremental capital and been true to that for the last 4 years. We still see those sectors as having really strong sectoral tailwinds that support growth. So WesTrac playing into mining production, and Coates and Boral playing into that infrastructure and construction, and obviously Beach into transitional energy. We are in a position, our balance sheet is strong, we have flexibility, but we see opportunity within the existing portfolio for growth, hence the upgraded guidance, but our focus is on continuing to deliver on that over the next 12 months. So yes, we're in a position we can look for other opportunities, but for us the focus is on the existing portfolio. That in the next 12 months will be a compelling opportunity.
So if there is any sort of history in all of this, it's generally when there is something that is significantly under pressure, which Boral was, which you go back in history, Coates was probably under a bit of pressure and you could see that growing out. So this means that cash, that ability that you have got, has A, got to fit that jigsaw puzzle, but then B, it's got to be the opportunity at the right time.
Absolutely, and that's a key point where we first identified a potential in Boral in mid-2019. At that point in time, we saw an opportunity in I'd say a Boral Australian as a business that wasn't performing to its potential, confusion around some international assets, and market probably disquiet around that. We thought the price wasn't right at that point in time, but we did work on that and were patient. We started acquiring shares effectively in March 20. As soon as we got confidence through COVID our business wouldn't be shut down and we could trade through, then we started acquiring shares. So we were very patient to wait until that opportunity. From our perspective, we don't have an advantage in the cost of capital. We need to make an acceptable return on our capital, so we've got to buy right. And then have confidence we can execute. But
it's also fair to say you got a lot more shares in Boral than what you first anticipated. You took on a lot more debt. So in other words, that was a big, bite to take on at a time when really the world didn't quite know where it was going to at that stage.
When we got at. We ran through that position where we got 20%, we got representation on the board. As a director, we were able to understand, get confident around the potential and some of the issues in the business, and we felt there was a requirement to be more active in driving that change and hence try to increase our position. The takeover, we weren't quite sure where we'd end up. Didn't anticipate having a change of control process, particularly given we weren't paying a premium, but we ended up in that outcome. We knew our business could sustain the leverage and work that down even without control of the Boral cash. and also the deleverage through the divestment of some of their assets, which was underway. So we were confident in our ability to manage that. At the point in time, it was a lot to take on. In hindsight, we've been very pleased it ended up that way, because we feel the business is now starting to show its potential, and we still think there is more potential within Boral to increase our performance.
Take me to the bigger picture right now in Australia, its economy. You can see that you've got nickel mines closing, you've got lithium mines under significant pressure. These are customers potentially of WestTrac and or Coates Hire, and maybe even Boral as well. Are you worried or concerned about the impact on your business of some of the pressures in the mining industry?
Look, in short, no, and mainly because over time we know the Australian mining sector is an incredibly innovative and world-leading sector. I mean, the innovation coming out of mining it spreads around the world. We have the best, lowest cost iron ore miners and highly efficient coal miners. We have a very effective sector. I think what we're seeing in lithium and nickel, our view is in the lithium sector, the demand for battery materials is going to continue to grow. Yes, it might not be as quick as what commodity prices may have assumed, but over time, electrification is going to occur, and that theme is going to demand an increase of lithium. So if you look at long term, that is going to that demand will be there. They need to get to a position where, I think, from an emerging sector into a mature sector, where they can apply the same efficiencies that have been applied across iron ore and other areas, where you get the most efficient, most effective operators in that sector. We believe the Australian lithium sector can be global leading.
Geez, if I was an investment banker, I'd be saying to you right now, you've got transitional energy and gas.
Yeah.
You sound like you're almost trying to talk yourself into lithium.
The sector's interesting. I mean, from our perspective, we try to avoid stepping in areas where we compete with our customers, and so we'd rather support them in their ambitions to roll out some of those mines, support them with the equipment to actually make sure it can be world-leading from a productivity and cost perspective. And I think that's where we see the lithium sector going as it kind of matures. But well, it'll be a key part of the Australian economy for a long time to come. So we look through this current commodity price fluctuation and think it's a very healthy sector.
So do you see Seven Group as being a domestic business, an Australian business, or do you think that the Coates Hire model, for example, could travel the world?
Yeah, we've thought around how do we look at ourselves, and have seen a key strength as being an Australian business. Almost kind of with a desire to kind of exclude and divest of areas where there are kind of overseas operations.
Well, you sold all of Boral's overseas assets, for example.
We don't have any other kind of. We sold WestTrac China a long time ago, so we exited that business as well. And part of the logic for us is we think this. We're big believers in the Australian economy. We think having local operation gives you a competitive advantage in that context, and run well, we can drive value here, and we think this economy's got tremendous room for growth, and from a business perspective, there's lots of ample growth opportunities, so we're not constrained in this economy. So from our perspective, we'd rather stay true to take advantage of the economy here than necessarily looking for global growth. I think the other challenge is an Australian business, it is really hard to get scale internationally from a base here in Australia. And we look at the global players in rental, and they're multiple times bigger than Coates. So to think that we can go into other markets with an advantage is challenging. So we'd rather be very good at what we do here and look to grow in this economy, which we think is one of the best places to invest than kind of other jurisdictions.
Okay, so I want to go back. You mentioned customers before and about the impact on customers. One of the things that's impacting your customers right now is changes to industrial relations laws, and in particular the clampdown on labour hire companies. A lot of the customers of Coates are labour hire companies, after all. A lot of the customers of, say, WestTrac might be labour hire companies. Do those industrial relations laws impact your customers and you directly?
It's going to have a change through the sector, absolutely. I think the way we look at it is we're all in the same boat, dealing to the same legislative environment, so we need to adjust and adjust models accordingly. It's not as clear as to how that will play through specifically. Labour hire is an interesting avenue as to how it's used. I think where it's used to take costs out, I think will be a challenge. Where it's used as a swing production source as far as dealing with variability, where it's usually at a premium. I think that's where it depends on the type of application.
The government has to be careful about this, surely. If it affects Australia's competitiveness, if it affects its flexibility, then surely Australia's government has to be careful about the laws it brings in place that might curtail activity.
I think particularly where sectors are highly efficient and require that efficiency and flex accordingly. So yeah, we're conscious around the need to provide that flexibility and that impact that may have. From our perspective, we don't think it'll be as big an impact. I think where we might find it's going to have impacts on efficiency and cost here in certain applications, but probably not so broadly. So I think it depends on the type of application of the use of contract labour. For example, in our operation, it's not the bulk of what we do, but as far as how do you deal to short-term variance where you don't have the workforce in your full-time employee base, and you can bring contract labour in, that's how we need to make sure we get that balance right. I think it's just, but working around existing EAs where you're trying to get a cost differential that's cheaper, I think that seems to be the intent of the legislation. So I think there may be elements where it's going to close what are considered loopholes. But big changes at IR and how they may impact key industries is something which we need to be taken very carefully to make sure it doesn't disrupt what's a competitive advantage that Australia's had.
Okay, I can't help but finish with an observation, and that is during this week, Seven Group shares have hit new all-time records. The value of the business is now $14 billion. The value of one of your holdings, which is Seven West, the media company, Channel 7, the West Australian, is worth $320 million. This whole business was built around those media assets. It's now minute in the scale of the whole business. As a conglomerate, why do you hang on to it?
Look, we've been quite clear, around our application of capital towards the three sectors, and we've been true to that for a long period of time.
Yeah, but that's not one of the three sectors.
Correct. So we still believe there's value. We don't think the market's probably ascribing true value to what the business is worth.
I get that, but is the return on the equity that you've invested there relatively small compared with the rest of it? As a conglomerate, where's the discipline?
Look, we're disciplined in how we manage each of the assets in the portfolio, and over time have shrunk that through divestment and through acquisition. The discipline for us is how we apply capital. That's really kind of the key issue. So if we think through Seven West, that capital we haven't changed since the formation of SGH since 2010. So it's been quite static in that context. We haven't looked to... Well,
is it kind of because you like it? Is it kind of because your dad, Kerry, likes it? Is it kind of like... Is that part of the reason it's there?
But we believe in the power of media and the opportunity with it in the context of what it can do from a cash generation. There's no question the cyclical forces are kind of probably more acute there, and certainly than any other part of the portfolio. I think from a group perspective, we've grown in different areas, and I think the market is recognising the diverse nature of the group and one of the hallmarks of our ability to reposition towards other sectors.
And do you have buyers lining up to actually buy it off you?
Look, at this point, it's not for sale.
I know it's not for sale, but you have buyers lining up anyway.
I think there's always... What we'd say is I think the sector's going to go through periods of consolidation, and I think given the current cyclical pressures that are impacting the ad market, it's likely that we'll see additional consolidation within media. And I think Seven West well positioned to try and facilitate that, and I think the acquisition of position within ARN further kind of reinforces the desire to be a bit more active in that context.
Ryan Stokes, always good to chat to you. Many thanks for your time.
Thank you very much, Ross.